And good morning. I think we're going to start the program now. My name is Darlene Chu Bryant. I'm the Executive Director of GlobalSF, and thank you for joining us today for a webinar on how to fund your business. Before we start today's program, the program is simple. Our guest speaker will share a PowerPoint to highlight some very common topics to kickstart today's conversation, and we'll continue with the chat, and we welcome questions from the audience, as always. Please feel free to insert questions in the Q&A so that Steve can answer them. A little background about GlobalSF to start. We are a nonprofit organization focused on leveraging our network and acumen to help companies land in California and thrive across the globe. We specialize in foreign direct investment with more than $6 billion in economic impact since 2008. We also advise companies on export and import issues. To provide no-cost advisory services to many clients, we are also an SBDC affiliate partner. And as part of the Small Business Development Center network, we have more access to services and answer questions on financing, whether companies want to expand their business, fund an import or export, or even startups that are looking for seed funding. In addition to the pre-pandemic world of startups, we definitely saw quite a few startups popping up during the pandemic, which is really good to know that our economy will continue to grow. So we are delighted today to partner with the SBDC Finance Center of Northern California and have invited Steve Roth, a veteran lending specialist, to talk about financing, all the different products available, and sources of funding to best suit your needs and your current situation. So welcome, Steve. I'm so glad you could join us.
Good morning. I'll switch over to the presentation, assuming the gods allow it.
Yes.
Here we go. Super. Well, good morning, everyone. I'm with the Northern California Small Business Development Center's Finance Center. We're supported by the U.S. Small Business Administration, the state of California. The program is managed out of Cal State Humboldt and has been really since its inception about 20 years ago. The core attribute of the program is free counseling for small businesses and entrepreneurs. We help roughly 2,000 companies a year raise money, create business plans, develop financial pro formas, network to banks, etc. The Northern California area is roughly Santa Cruz east to Nevada and then north to the Oregon border. It includes all 30 counties in Northern California. Signing up for services is really simple. The financingsimplified.com link is down below. If you click on that, that'll take you to a registration page. Register, become a client, and the services, again, are free to everyone. The Finance Center is a little different than the local small business development centers. Throughout Northern California, I think there are 18 small business development centers that operate on a county or multi-county basis. And they're there to provide a lot of hands-on services to new businesses, people thinking about getting into business, etc. The Finance Center was set up 3 years ago specifically to help companies raise capital. So our focus is much more on raising money than other kinds of activities. I'm a lending specialist across all of Northern California. My email, NorCal Feel free to send me a comment or a question after we're done. The Finance Center has 3 of us as full-time lending specialists and a team of 15 experienced professionals that can help for a variety of other functions such as HR, legal, etc. My background, most of my adult life, capital and private equity investor in Boston, general partner of some 10 different private equity funds. I've started over 25 companies, and over the years, I've raised a lot of money for a lot of different businesses, north of $1.5 billion of debt and equity. And for myself, I've done business all over the world since 1977. I've run global businesses, and I've been involved in businesses that that we owned and invested here in the United States that shipped product to 50, 60 countries around the world, dealt with multi-level distribution systems in different countries. Again, my email address. And for the SBDC, our fiscal year 2020, and our fiscal year is the federal fiscal year, so it ends on September 30th, but as of September 30th, 20, the regional SBDC network had raised just under $500 million for companies. The Finance Center was responsible for about 119 million, roughly 25% of. And the Finance Center is off to a great start in fiscal 2021. We've raised over $90 million. I think as of the last reading, it's actually now over $100 million for clients since October 1st. And as of the other day, I think $2 million raised for clients. And obviously we're here to help you. So we're ready to help you raise capital. So for today, we'll take a look at different types of funds available, sources of funds, uses of those funds, general timing and terms, and some general underwriting criteria that most banks look at, and reserve time for questions and answers. So one caveat, raise the money first. Make sure you have a business plan. You have a 5-year or so pro forma. You know how much money you'll need to accomplish the mission of the business, and raise the money before you start operations. Nothing is worse than spending all of your equity, your cash, and then running out of capital and trying to raise money on the fly. You want to be able to raise the money before you begin. So types of funds. At the core, you really have two kinds of money. You have equity and you have debt. They have different roles in the company's future. Equity is very straightforward. Equity operating losses. That's the primary goal of equity. It also provides the basis for debt. By federal law and general banking convention, banks can't lend more than 3 times equity to a company. So 3-to-1 is the maximum debt to equity ratio, the maximum leverage. So if you have $1 of equity, you can raise $3 of debt. You can't raise $3 of debt if you have 50 cents of equity. It also backstops the debt. If anything were to happen and the company were to have a problem, the debt looks to the equity to take care of that problem. And that equity is for. And it's also designed to take the risks associated with startups. Lenders are not oriented towards startups, equity is. Debt has a different role. Debt's function is to fund asset growth. It might be fixed assets in the form of real estate, property, plant, and equipment. It could be equipment. You're growing your business, you need another machine, you need packaging equipment. But the key is that the debt must be repaid. Equity does not have to be repaid. Equity can lose everything. Debt is not supposed to. All debt will be personally guaranteed, and all debt requires collateral. Basically, for a loan, the bank will look to about a 1-to-1 collateral ratio. So if you want to borrow $100,000, you need $100,000 in collateral. The partners in the company will personally guarantee the debt, and they'll be primarily responsible for repayment. Equity is supported by future profits. Equity expects to make an equity return, meaning 25% compounded per year. So I put in $1 today. At 5 years from now, I expect to get $5 back. That's what equity is supposed to do. Equity looks to the business plan, sees where you're going to go, what kind of return you might get on that investment. Debt is supported by current cash flow. Debt expects to be paid every month, just like your mortgage. And it looks to a level of cash flow protection that's called the senior debt coverage ratio. And basically what a bank or any lender will look for is about $1.25 of cash flow for every $1 of principal and interest payments required. So if you were to borrow money from a bank and you have $10,000 a year of principal and interest payments, the pro forma, your prior financials, your going forward financials need to show about $12,500 in available cash flow. And that's to make sure that the loan stays current and the business within certain parameters and small glitches. Small glitches do not include COVID. COVID was a big glitch, and the Congress and the SBA implemented a plethora of programs to help companies make it through the last 18 months. The programs are, and those programs are basically ending as COVID ends. Collateral is a second source of repayment. Personal guarantees are a third. But remember, debt and equity work together. There are legal limits on how much leverage you can have in a company. So you have to be able to think of equity as part of your long-term capital plan. Now, sources of funds for equity, it's pretty basic. You have your own capital, which again, you should not start spending until you've raised enough money to take the company to a meaningful milestone. You also have your channel partners, people you buy from and sell to. In the world of international business, many times we source products from China. Chinese manufacturers require a significant amount of upfront payments before they'll ship. So usually when you place your order, you put down a third. When they begin to manufacture, you put down the second third. And before they ship, before the products go to the port to get on the boat, you pay the final third. So if your channel partners can provide you with trade credit, it reduces the amount of equity you need. The same on the other end with people you sell to. If they're normally get 30 to 45 days to pay you, but they're willing to pay you in 10 days or willing to pay you on delivery, it greatly reduces the amount of equity you need to start the company. Corporate investors, you may find that your business impacts other businesses and those other businesses are interested in what you're doing. We had a company that was importing product from India. We knew how to get product out of the Indian market at a high quality and on time. And other companies actually asked us to help them do the same thing, and they paid us for it. So we took a cost center and turned it into a profit center. And then lastly, institutional investors, whether they're angels, high net worth individuals, institutional investors provide long-term money to 7 to 10 years for profits. In September, we'll be doing an expansion capital seminar, and we'll have chairman of the SAC Angels on the panel. Debt, again, comes in a variety of forms. You have conventional bank, and bank lending can come in the form of a credit scored product, like getting a car loan. You go online, punch in your social security number and your birthday, and they tell you can borrow so much money at a certain rate. Most of the products for companies are not credit scored, but bank conventional lending programs that are not backed by the SBA or any state of California programs. The SBA has two major programs, the 7A program, which are term loans for companies of all kinds. The 7A program also has an early stage loan program known as the SBA Express. SBA Express loans can be up to $1 million. SBA 7A loans can be virtually of any size. There's also a special program for people who want to buy owner-occupied real estate, and that's called the 504 program. So this is the real estate that your company will occupy as its primary business location. It's not for purposes. So you don't use the 504 program to develop houses that you might sell off to individuals. It's for your own space. You also have leasing companies, which are very active if you need equipment, and working capital factors. So inventory and receivables are often a big part of the cash needed to get a company started and get a company in operation. Banks do not like to loan against inventory and receivables as a standalone basis. And there's a network of specialized companies. Some do only inventory, some do only accounts receivable, some do both. And they're the ones who can help an early stage company get going by financing their working capital. So if you have a contract and you need to buy product, build inventory, get raw materials and make product out of it, or you're shipping to the state of California and they're going to take 60 or 90 days to pay you, you've got to figure out a way to finance that working capital need. Uses of funds. So remember, startup and early operating losses are basically the equity. A bank will not fund operating losses. Capital structure support. As a company grows, the equity needs to be kept in the business as part of increasing your net worth. As your net worth goes up, so can your debt. You need to grow your working capital. And this is typically in Northern California, this is typically a very big problem because we're not a big manufacturing center. We deal in intellectual property businesses and high value added. And so growing your inventory and your accounts receivable is often the biggest single use of funds for most companies. Real estate is very leverageable. And there's a lot of sources, there are many sources of debt, including the 504 program, banks, straight 7A loans to fund real estate. The same is true with equipment. Debt likes assets, and the more fixed the asset and the longer term the asset, the more they like it. But you can also do debt and acquisitions. I've done perhaps 6 acquisition financings in the last year, one company buying another, or a company buying another business, and they're actually quite easy to do. So general terms and timing, remember that raising equity can take a very long time because the equity is making a fundamental investment in your business as a business. They're not supported by any debt. Any debt that comes in after the equity comes in will take a first position in all the assets. So the equity really is counting on you, the founder, the management team, to get the business to a point where you can sell it, take it public, do something with it, and create an equity return. And remember, the more equity, the better. It's safer for the lenders, it's safer for you. Equity is going to look for a 25% compounded return on their investment, a way to liquidity, and an experienced management team. Lenders will as well, but the management team is most critical to equity investors. Raising equity can take upwards of a year. So you have to give yourself enough time to do it. Raising debt is about a 90 to 150 day, 3 to 5 months. Lots of documents required by the lenders. So when you start into the debt business, in the document upload business, it's not a mortgage where every document you've ever produced has to be uploaded to the bank. And in this case, there are more documents than that. The business plan doesn't have to be long. As a matter of fact, long business plans simply won't get read. So 4, 5, 6, 7, 8 pages focused on how the business is going to grow, what the key drivers are, what it looks like when it gets bigger, how long, if you're going to have operating losses, how long the operating losses will be there. Financials, past, obviously, if the business exists, but also financial pro formas. And the financial pro formas have to focus on the senior debt coverage ratio. You're going to borrow money, something with it. What you're going to do is going to influence the company and how it's going to grow. That's going to be reflected in future profits, cash, and it's the future profits and cash flow that the lender looks to repay the loan. Tax returns, personal financial statements, resumes, these are all part of the process. Remember though that every equity raise is unique. They're all a series of one-on-one negotiations. If I'm raising money from my company, then the equity from my company is going to be a function of my plans, my experience, the experience of my management team. Whereas raising debt is more or less a similar process with any lender you go to. They're dealing with fixed products or similar products with similar terms. So the debt from one bank is not going to be terribly different than the debt terms from another bank. And lenders are going to match the term of the loan with the life of the asset. And by that, the old joke is you don't want to buy a house card, right? 30-year investment versus changing interest rates. And you also don't want to take out a 30-year loan to go on vacation, right? You want to try and match the useful life of the asset with the timing of the fund. So on a real estate loan, you'll be looking for 25-year amortization periods. On equipment, probably 10, maybe 12. Shorter term loans are all around 5 to 7 years. Working capital are very short-term loans. They revolve with the business cycle. Long-term assets can go out for 25 years. So the bank gives match what's being financed to the kind of money you're using. Equity is looking for a 25% rate of return, partnership. Debt needs to be repaid. Debt basically can take, in today's world, 3% is about the lowest interest rate on real estate deals. 12% is about the highest. There'll be personal guaranteed. There'll be credit enhancements, co-guarantors to make sure they do get repaid. Lenders have a legal obligation to ensure return of capital and to be able to show that there are at least two ways for the money to be repaid. Whereas equity investors understand that if the business doesn't work, they could lose everything. So some general underwriting criteria. When you go into a bank, it's 2 to 3 years in business, at least 1 year of profits and positive cash flow, a debt service ratio, senior debt coverage ratio of 1.25 to 1, with the senior debt coverage really being the critical number pro forma. Collateral to support the loan. Credit score of 680 to 700 is usually fine. Below 680, you should get it looked at. Now, the management history, have you done this before? One criteria that the banks, the SBA, everyone looks at is, does the management team have experience in this business doing this activity? Because prior experience on the management team is the number one predictor of future success. If I want to open a restaurant and I've never been in the restaurant business, God bless me, why would anybody lend me money to do it? They won't. So banks lend directly when all or most of the underwriting criteria are met. The SBA programs are basically a credit enhancement for those borrowers where they don't meet all of the bank's criteria. The business is not 3 years old. It hasn't been profitable for the last 2 years. But the SBA, it's important to remember, is not a direct lender. You don't go to the SBA to borrow money, except in one case. But general business loans, you don't do that. The SBA provides a backstop guarantee to the lender of up to 90% of the value of the loan. So the borrower, though, is the primary on the loan, not the SBA. So the SBA and the bank would expect the borrower, the collateral, to repay the loan in case the business can't. The SBA is there as a backstop. Without the SBA, the bank wouldn't make the loan because there's not enough collateral. There's not enough history in the business. The 7A loan program are for business loans. There are about 5,000 banks in the United States that do 7A loans. Virtually every bank, credit union in the Bay Area and in California in general will do 7A loans. They'll have a specialized 7A loan lending officer. The 504 program is for real estate loans. The 504 program does not work through banks. The 504 program works through a separate group of companies that are called community development corporations. These are nonprofits, and they're the entry point for the SBA 504 borrowing program. Bank lending 504 and 7A can be used in combination, but when you have a 504 real estate loan, you get a straight bank loan. 7A can be used when you have a working capital facility on top of the real estate purchase. But again, we're happy to help you with all of this stuff. So remember, your SBA loan process starts. The key thing, the SBA is not a direct lender. The bank decides to make the loan. It decides it needs a partner or a credit enhancement. So the borrower works with the lender works with the SBA. You, the borrower, would probably never speak to anyone at the SBA. Probably wouldn't even know that they were there. You'll sign some papers, but other than that, it works through the bank. The SBA, the finance center, are here to help throughout the process. And we help clients get into and through the loan process, because the most critical issue is finding a lender that likes your kind of business. They do this kind of deal. They have underwriting experience in what you're going to do. And so finding the right lender is as important as anything else. So in summary, equity funds operating losses. If you're a new company, a startup business, what you're going to do going forward is going to create a new market and generate operating losses. You have to have equity to cover that. Debt funds profitable expansion, cash flow and equity. For both debt and equity, you'll need a business plan, financial pro formas, management team. So, my advice is always to get help early in the process, be realistic about how long the process requires, right? You can't run out of money on Wednesday, call up and say, I need a loan by Friday. That's not 90 to 150 days. And always raise the money first. Make sure that the money matches your plan. I call it Roth's law of the conservation of capital. Right? You can't show a business plan that calls for creating a biotech company with $1 million of $1 million investment, nor does it make any sense to think anyone's going to put $10 million into a coffee shop. So, the money in and the money out have to make sense for one another. And with that, I'm happy to switch over to any questions anyone has. I've numbed you all into complete submission, which is always my objective. There's one question.
There is one question.
Yeah, so
yes.
how do you find a lender that likes your field of business, which is obviously the critical question. It's a great question. And the answer is talk to us. I've probably worked with 35 or 40 lenders throughout the Bay Area, and they all have a particular interest in one kind of deal or another. That's true with banks, credit unions, as well as the 504 lending community. So one 504 lender, even though they all access capital out of the same program, one 504 lender likes restaurants. Another 504 lender prefers medical practices and likes to do professional office space. Another has a big investment or a lot of expertise in industrial space. And network you to the right contact. And once you get to the right type of lender, it all makes sense and comes together pretty quickly. So, well, I think, wedding and event centers. The next question is, do you have a lender that likes wedding and event centers? And the answer is yes. There are ones who like that, but again, it's a function of the business plan, right? So no anything in abstract, but there are lenders who do those kinds of service-based businesses and who have a lot of experience with service-based companies, where you're not creating a physical product, but you're creating a service for people. And that could include caterers, consulting firms, anyone who doesn't have a physical product to sell. And they can be very good and easy to do. They're very easy to do on a real estate basis. If the goal is to finance the real estate business, it's actually almost easy just financing the business because the business doesn't have assets.
So Steve, I have a question for you. Is there a difference, because we hear about programs offered by the state of California as well? So what are the differences between SBA programs versus California programs?
Sure. Yeah, the state of California has several programs, and the biggest differences are that the California programs are smaller. So the SBA programs are measured in, tens of billions of dollars. California's programs are measured in hundreds of millions of dollars. California has a great micro loan program, which is carried out by what are called CDFIs, Certified Development Financial Institutions, credit unions, smaller lenders. And those microloans can be very useful for smaller businesses that are getting started. The micro lending program has one disadvantage though, and that is it's fully underwritten. So to get a $50,000 loan through the state of California's micro lending program is just as getting $1 million loan from Chase Bank. You need a plan, you need a financial projection, you need all the same stuff. And the state of California also does loan guarantees. So if your need is larger than a micro loan, but you also need a partner, there are certain instances where the state of California's loan guarantee programs can do the same sort of credit enhancement the SBA does.
There's another question from the audience. From where shall we start?
The beginning. Beginning is always a good place to start. Sounds like a joke, but essentially, you know, you want to start out with a basic idea of what the business plan is, even if it's only bullet points, and you know, some idea of sort of how much money you have. Remember, you know, all lenders will require some level of equity in a company. They have to. So you can't start a company with zero capital because 0 times whatever is 0. So you'll have to have some equity in a business and then make sure it fits. So we did we got a micro loan done for a startup in the Sacramento area through a group called California Capital, part of the state of California micro loan program. They'd started a business plan. We needed to refine it. They had projections. It needed to be changed. The founder had excellent experience in the business. She put together a core team, knew what she was doing. She got licensed. She put up $25,000 of her own money and spent it well. And we raised another $67,500 in a term loan through the microloan program for her. But it all starts at with a business plan. You know, what are you going to do? Why does it make sense? Do you have expertise in doing it? And that's kind of the beginning of the process. What does a loan with a guarantee offer that one without a guarantee does not? Well, remember, you know, there are no guarantees. The guarantees come from you, the borrower. The backstop guarantees essentially provide a credit enhancement. So without it, the bank wouldn't make the loan at all. So remember, the bank has a legal obligation to have at least 2 ways to be repaid. That's federal law. The first way is the happy way, which is that the bank will, you know, the business will do well and the business will repay the loan. But they have to have another way of doing it. And so the SBA is basically a third way of doing it. If the business fails, they look to the borrower and the borrower's assets, the borrower's collateral to repay the loan if the business goes under. If that's exhausted, then they would look to the SBA as a way to get back the money in the final analysis. So you have to think of it as without the SBA guarantee, you'd never get the money, period. And there's very little cost difference between a loan with the SBA and a loan without the SBA. And between now and September 30th, when the program ends, the SBA is actually waiving all fees on all loans. So if you do want to get anything done, there's not much time, but you do have, you know, 75 days. So getting a loan done by the end of September can save 3, 4, 5% in total fees associated with the loan.
That's definitely a lot. You know, you touched a little bit on trade financing, but the thing is that but in terms of trade finance, are there products available to ensure or protect the payments of receivables?
Yes, you can get insurance to do that. Yeah. So, but it might be more expensive than you'd want. Generally people, they'll try and factor the receivable, depending upon who you're selling to. So if you're bringing in product, I've got a contract with the state of California, they're going to take 60 days to pay me. Then I find a factor as a partner. The factor actually buys the receivable from me. So
Oh,
they own it. They deal with the state of California for me. I may be a small company and I don't have 5 people running around to follow up on it. So they'll do that. They give me, say, 80% of the accounts receivable in cash. That allows me to pay my vendors. And then when the receivable is collected, I get the difference after any fees. Very good way to deal with working capital financing early on. The hardest thing to deal with is overseas inventory payments, because no U.S. wants to ship money to a foreign country where have no way to, there's no protection for it. So if you're going to start a business that's going to acquire product overseas, you have to have a way of financing at least the first round of inventory shipments. And that's usually, from what I've seen, the big failing in the business plans. They do not have enough equity to begin placing orders 90, 120 days before they're going to get the product, right? Because typically, whether it's India or China, when you place the order, you pay a third, and that gives your manufacturing partner the money it needs to buy the raw materials. When they begin manufacturing, you pay another third, and that reimburses them for the cost of the labor associated with creating the product, putting it in a box. And then when it's all done and it's quality controlled, you pay the final third, it goes on a truck, it leaves the factory, goes to the port, and off it goes. And that's kind of the tricky part, because you've got to have a way, you have to have a partner in country to do an outgoing quality control check. Otherwise, when it shows up in San Pedro or Seattle or Oakland, it's too late to go back and fix the problem. And that's what one of our portfolio companies did for large retailers all over the United States. We did all of the outgoing quality control checks. So again, every business is a little different. I have seen some of the foreign manufacturing sources willing to deal with companies, give them different terms, let them pay, when the product gets here, so you don't have all of the money advancing so early in the process. There are a
sounds
couple
good.
more
And then we have
questions.
a few more questions coming in. And one question related to the item that we just talked about is what is the percentage or the fees do factoring lenders charge in general?
Well, for SBA loans, the fees are probably 1 to 3%.
Mm-hmm.
So they're not very much. If you get a loan for $100, you pay $3,000 in fees. They're not significant. Factoring is more expensive because the factor is acting as your accounts receivable collection agency, and so they're going to charge you for that. But in general, fees are not a major limitation on the deal. Catherine asked, are there any grants available for new businesses? And the answer is no. There are no grants available for new businesses. There really never are, unfortunately. And even during COVID, all of the COVID programs were directed at existing businesses to help them offset losses due to COVID. So you really need to go out and raise equity to do that. The webinar is being recorded and you can share it. Darlene, you want to tell people how they can get the recorded version?
Yes, first of all, we will be sending emails to all our participants who join us today. You will be getting an email with to the recording, as well as contact information on how to reach Steve, as well as how to sign up as an SBDC client if you haven't already. And also on our website, globalsf.biz, there is a link to all the past recordings if you want to refer to any subject that we've actually discussed. There is a library of past webinars that you can refer to. So do stay tuned. Thank you.
And then someone's asked, what's the most common mistakes most borrowers make? And the answer is they're too optimistic. The rule of 24, and that's not the old TV show. The rule of 24 is that everything takes twice as long and costs 4 times as much as the most pessimistic scenario any entrepreneur put forth. So remember, things don't go as you think they will. Have room in the plan for mistakes to happen, for delays. You know, the product will not be shipped exactly on the 28th of July, and it will not get to the port exactly on the 3rd of August, and customs will not process it in one day. So they basically wind up with too little capital. I used to do something when I taught somewhere else, which was the number one reason small businesses go under is they're undercapitalized, which basically means they have too little money. So there's no such thing as too much equity in a company, especially early, and plan for the worst, hope for the best. And another question, if we want to open a company with quite a bit of equity, such as enough to cover the first year's operating expenses, what options exist for loans to cover future operating costs and startup equipment? So it's a good question. Remember, so I have a client, they're in the Sacramento area. They raised $1.5 million in seed financing, and then they raised $8.5 million of startup financing. So in total, they'd raised $10 million of capital from a combination of institutional investors, funds, venture capital funds, high net worth individuals, other individuals, some corporate partners, to create a new high-tech food product. Based upon the equity raise, I was able to work with them and Silicon Valley Bank. And Silicon Valley Bank gave them a $2.5 million credit facility. Now, they had no revenues, they had no profits, they have no cash flow, but they had $10 million of equity. And the way the deal worked, which I'd done before in the venture business, is that the investors gave the bank a make good provision, so that if net worth in the company fell below $4 million, the investors had to put more money in to bring the net worth back up to $4 million. So they kept the debt to equity ratio in a reasonable line. They couldn't just lose all the capital. And that deal worked. And so the company used the $2.5 million credit line to do things that are not good uses of funds for equity, like buying equipment, trucks, right? You don't want to take equity and buy a forklift that has a useful life of 3 years. You want to do that through a debt financing, but you have to have enough equity to make it work. So if you raise enough equity, you can get some debt even for early stage companies, but it's going to be more limited. Remember, the maximum debt to equity ratio is 3-to-1. So this other company had raised 10 million of equity. It could have theoretically raised $30 million of debt. We only raised 2.5 million of debt. So the debt to equity ratio was 1/4-to-1, much less than maximum. And then can a borrower have different SBA microloans from different microloan lenders, each max at 50K? And the answer is, you might be able to do it, but it's probably not going to be easy, because in full disclosure, you have to tell the lender, how much debt you have, and they're going to look anyway. All of the microloans will come with what's called a UCC1 filing. UCC stands for Uniform Commercial Code, and 1 is just a number on the document. And that's how the lender lets other lenders know that they have put money into the company, and it may be secured by an asset. So every lender who's about to make someone a loan will go to the state of California and do a UCC1 search. And so they'll see all the debt you have. And you wouldn't want to not be honest about it, because that would be bank fraud. And that would mean you'd be in orange for 4 to 5 years. And unless you look really good in orange jumpsuits, I would avoid committing bank fraud for 50 grand. The level of grief would way outstretch the the benefit of the capital. So remember, when you're dealing with a lender or an equity partner, they're partners, right? You want to talk to them. You want to keep them informed. You want to let them know what's going on, good or bad. Once they've made a decision to work with you, they'll stick with you, unless the results are so terrible, that they can't in good conscience loan any more money against it. But the last 18 months with COVID, between the congressional programs, the SBA programs, bank programs, very few companies have gone under. Not zero, obviously, but companies have toughed it out over 18 months because they've been working with their lenders to get through a very difficult time. So I wouldn't think that that's a good strategy, because it's a lot of work to get a microloan. The one I talked about in Sacramento for a home care services business took 5 months from beginning to end, including me making a presentation to California Capital's Finance Loan Committee to get it approved, and then post-closing documents. So it's not a good approach to things, I think. Good. Any other questions?
Yeah, Kathleen Lorenzo has, did we answer that already? No. Yeah, if we want to open a new business with quite a bit of equity, such as enough to cover the first year operating expense.
Oh, I did. I answered that.
Okay. And
Yeah.
then Lee Hong asks, can a borrower have different SBA microloans than different microloan
That's the
lenders?
one I just answered. The
Okay.
answer is
No.
not without committing some level of bank fraud.
Yes, we don't want to do that.
Don't want to do that.
Great. Any other questions from the audience? We still have a little bit of time left. So when you're a business, most important thing when you're applying for a loan is watch out and don't commit fraud, right?
That's right. That's a good idea.
I think that's the most important thing. And then
Most
two,
importantly, give yourself enough time for the process to work. Because whether you need money in a day or 2 days, the process is going to take 90 to 150.
good to know.
So someone said they didn't get a question answered.
Which one is that?
I didn't see it.
Why are banks loaning personal without equity these days?
Do you mean like small? I don't know. Peter, I think the best thing to do would be to email me, and I can answer the question offline. We're talking about business loans rather than personal loans. So personal loans are very different than business loans. Personal loans from banks tend to be credit scored. And you can get offers for personal loans all the time, but it has nothing to do with getting a business loan or an SBA backed loan. And the big difference is they tend to be small, right? You don't tend to get $1 million personal loan offers, right? So they're all in the kind of, the teaser mailers are, you've been approved for up to $58,000 at 0%. And when you actually fill out the questionnaire online, you're really approved for, $20,000 at 14%. Criteria being the same. Would you like to just put it into the Q&A box again, and I'll answer it? I can see your name, but. Oh, crowdfunding. So the question is, does that apply to equity crowdfunding as well? Well, crowdfunding is a very specialized area, and generally crowdfunding does not work for 99% of the startup businesses we see at the SBDC. You know, you don't borrow money in crowdfunding to open a coffee shop, you know, and it was thing that was supposed to dominate the venture capital space. These small crowdfunding sources. 10 years ago, when I was working with the SBDC in Oakland and San Francisco, before the Finance Center, there were a lot of crowdfunding alternatives, and they've all basically gone away. So I wouldn't think of crowdfunding as a good source of significant equity capital in today's world. And but you know, again, it's a one-off. You know, every equity investment is a one-off decision. People have to like what you're doing and they have to see it. But back in 2006, 7, and 8, there must have been 20 crowdfunding debt and crowdfunding equity startups. I haven't heard of any of them in the last 5 years. Certainly, they haven't come up in anything I've done with the Finance Center. Whereas angel groups are a much more dominant player. But if you want to email me offline, I'm happy to talk to you about it. Great. She said she will.
Great. Any other questions? We still have a little bit more time, a couple more minutes. This has been really informative. I mean, I had a list of questions too, but you already went through them, so I didn't have to ask you. Okay, how do you go about finding angel investors? Oh, dear.
That's a good question. So you should come to the expansion capital program we're doing on, I think it's the 26th of September. We'll have the chairman of the Sacramento Angels, but angel groups tend to be smaller and more localized. So there's one in Sacramento. I know there's one up in Shasta. There's one in Napa, Sonoma. And they tend to be focused around businesses where the people in the angel group made money. So, you know, if you want to fund a retail business, you know, the chances are pretty good the people at the Silicon Valley angel network are not going to fund it because they all came out of the high tech world. And so what happens is that if you're in the business of retail, technology, software, restaurants, you'll network to other people in that space. And we can help you do that. Yeah, I think the thing to do for the real estate program and then we'll do the real estate program and the expansional capital program again in September. The best thing to do is just go to the SBDC, the NorCal website, and there'll be a link on the website to check in. Or you can email me and I'll have someone send you the link.
Or just remember, you can always check in with GlobalSF and we'll make sure you're connected.
Exactly.
Always a good thing. But I will also mention that there is no, I don't think there is a list of angel investors, PE funds or what have you. But the thing is, it's always good to network, which is why, especially in San Francisco and the Bay Area, there are little hubs or areas where people, all the VC guys, they actually hang out. You know, pre-pandemic, for example, the Four Seasons Hotel, the original Four Seasons was where a lot of VC guys would hang out. The Battery Club is definitely a place where a lot of these guys hang out. And then and again, it's all about networking. There is a group that are more, I would say, established where called the Band of Angels, where every single investor is looking at something different. And they also have different events where each event is focused on the different sector. So again, it really depends on what sector you're in, and that will dictate what type of a VC or what type of an angel investor you'll be speaking to. So that's just
exactly, Darlene. Yeah.
Cool. And with that, it's 10:59. If there are no more questions, I'm gonna say, you know, countdown. But I want to say thank you so much, Steve. You've been really providing so much information. I even learned a lot during today's session, and I'm sure our audience did as well. Again, I just wanted to remind everyone that this session is being recorded. It will be available on the SBDC sites as well as GlobalSF website, which is globalsf.biz. Everyone will be receiving an email from us to thank you for participating, and also remember to remind you, if you have not signed up for free advisory services from GlobalSF under SBDC, please do sign up when you do get our email, and then you'll be able to work with us as well as with Steve in the finance world. So we will help you with the business and business plan and marketing, and Steve can help you with all the financing. And with that, it is now 11 o'clock on the dot. I want to thank everyone again for joining us, and have a great day. Again,
Take care, everybody.
Take care, everyone. Bye-bye now.
Thank you very much for having me.
Thank you.